we going to do our...
Welcome, everybody, to another episode of the Good Deeds No Investing podcast. I am your co-host, Chris Seveney, along with Mr. Jamie Bateman here on a chilly, brisk morning here on the East Coast. Jamie, how are you today?
Good, Chris. Good morning. How are you?
Good. Got a little less sleep last night after playing cards till 1 o'clock in the morning with some friends. But, hey, I already had a cup of coffee in me.
Nice.
It is before 8 o'clock here on the East Coast, where we typically record on our Friday mornings.
I feel like I was just talking to you too last night.
Yeah, we were. I mean, we just got off the phone just about 13 hours ago or whatever it was, after we just did an interview with Dave Van Horn. So that episode will be out before this episode, so people can go back and listen to that. But before we roll into kind of what our trials and tribulations, today we're going to have an interesting topic where Jamie is going to grill me on my 5 predictions from last year and see how I did from a year ago. I'll give you a little prelude to it of I did not predict COVID. So just to let you know that. But it'll be interesting as we go through this. So today's going to be fun episode. But as always, before we start, Jamie, trials, tribulations, what do you got going on?
Couple updates to things I've talked about before. So last week I talked about how I was looking at this asset where the guy was pretty highly qualified, the borrower, and made 3 payments and then looked like he'd passed away. So I'd bid on this asset and was kind of excited about it. But turns out somebody came in and bought the entire tape, which actually plays into our main topic some. But
ding, ding, ding. Oh, I forgot to add that button to my little music thing here.
But the shocking part about this, I don't know this to be 100% true, but what the broker told me was that whoever the buyer was came in and bought the whole tape of non-performing loans at a 90% UPB at about a 5% yield, which is...
We'll talk about that in a few minutes too.
Right. I know. I will tell you, generally speaking, these were high equity, pretty highly qualified borrowers. So, the paper was clean and high quality, but still, I mean, really, like, I just couldn't believe that. So lost out on that one, but it was, good practice.
Any wins?
Any wins? Yes. My second update is the New York loans. They are not fully transferred yet, but we have approved goodbye letters, and FCI has approved the transfer date of 12/4. So in 2 weeks, I think, from today. So that's pretty exciting considering how much waiting and work we've put into this.
So as somebody originally from New England, I, grew up in the first memory. One of my early memories from sports was the Bill Buckner. Through the legs.
86 Mets.
Yeah, 86 World Series against the Mets. So it looks like it's in the bag, and then all of a sudden chaos hits. So on New York loans, I'm just going to say, let's just hope we don't have a Bill Buckner moment on them, because you never know who we're dealing with.
True. Especially since I've already paid
Not everything.
Not
actually.
Fully. But
yeah, I haven't seen it come through yet, though.
Yeah.
It checks in the mail, right?
Yeah, exactly. So those are my trials and tribulations for this week.
For mine, let's see. I so I had launched a new fund where we raised close to $1 million, and I got approximately $750,000 in assets under agreement. So that's a really good start to get the ball rolling on that fund. Also put in some additional offers yesterday on some assets. Finally, the seller is like, hey, I got a tape that we want to sell as a whole tape and send it out to a few people. Are you interested? And I'm like, sure. How quickly can you get bids? I'm like, when do you need them? He's like, sooner or better. Can you get it? He's like, tomorrow or today. And I'm like, yeah, I'll have it in 2 hours. So basically, went into data tree, started pulling up information and stuff, and my bid's in. So
that's impressive. You said you typically have, several bids out every single day, right?
Yeah, there's typically something in the pipeline that will slow once the new year hits. Because of what I've got on my agenda. I mean, when you launch a fund, you want to get that money working as fast as possible. So as you're gearing up to close it and everything, you start putting offers on stuff because you don't want to wait till the fund closes and then wait 6 or 8 weeks 2 months to not have any assets in that fund, because if you're given a preferred interest, that money's burning a hole in the pockets of doing nothing. So, so that's one of the kind of maybe a little note and bolt there from that perspective. Few interesting thing I'll mention this past week. I had to appear for 2 hearings in court because they potentially would have been bench trials, which were basically a quick trial with just a judge on 2 land contracts. It did not get to that point. One of them was a land contract in Michigan that had been going on for a while, where we did get the judgment. The borrower has 90 days to reinstate the loan from the forfeiture date. I'm hoping, fingers crossed. I'd really like to have this, work with this borrower if we can to keep the property. We made some offers to her, but in the past, it hasn't been successful. The other one was interesting because the borrower showed up late, was more than an hour late for the call. So the judge was not very happy. Did not have his attorney on the Zoom call because the attorney was in quarantine. So the judge said, it's a Zoom call. Why is it, he doesn't have to be here. He has to be on Zoom. Who's he quarantining against? So yeah, let's just say I just sat very quietly. It's kind of like, when you and, a family member go do something and the other one gets caught and mom and dad are screaming at them. You're just like, I'm just going to be quiet right now.
Yeah, my kids are very good at that.
Yeah. So that's some of the stuff this week. I'll mention one of the other things because I think this is another important tip. So I went and started, took a little while, but I started reaching out to people from IMN, the conference, which has been free for people to register on. And I basically went through, and when you on there, basically it gives you the list of everyone that's on, and there's a little email system in there. And I sent emails to many people on there and said, hey, this is who I am. I spoke, but didn't have time to touch base with you. Wonder if we could just set up a call, see what's going, see what your business does, learn about mine, and maybe there's a way we could potentially work together in the future, or just, know somebody who could help each other. And, I would say, it's probably a well over, I think, a 10% success rate in people responding back, setting up phone calls. And when you look at, hundreds of people, you're getting, not 5 calls, you're getting 50 phone calls with people. The first day I started calling people, I got, I think, 3 tapes. Wow. From investors. From that perspective, I learned a few more about REO disposition companies, some new cool software that's coming down the pike. Just by networking, and some companies, one company was a $5 billion fund in DC that, clearly there was not the ability for us to do business, but they just like to hear what, I'll say Main Street investors like myself are doing and so forth. And I like to kind of hear what they're doing and share what they think is going to happen in kind of what they're seeing, because they're talking, of course, at much higher levels of people than we are, to get and understand what's going on. So again, that's my second note and bolt for today.
Yeah, early for that's double feature. So just curious, they have which event was this that you were?
This was the
servicing one?
No, this is the one you and I spoke at.
Okay, got it.
So the servicing one is actually what I'm going to be doing next.
Okay.
Go through that list and pick and choose certain ones to set up some conversations.
Because that was a couple weeks later, right? Servicing rights. Yeah.
Yeah, and just because you maybe saw a few things on the event, and the event was 4 months, even if it was 4 months ago, still have access. Just go out and reach out to people. Never hurts. What's the worst they say? They don't reply.
Right. That's happened before, right?
Yes, that's happened a few times. So let's roll into our main topic today, where Professor Bateman is going to evaluate my thesis on my top 5 predictions, which were for 2020, this past year. because in upcoming episodes, we are going to do what Jamie's plans are for this year, what my plans are this year, and then we're going to do what our predictions are for this year. So we got multiple episodes talking about next year. So be interesting, but Jamie, I will let you take the lead on this, and I will probably get very defensive and try and spin it in a way to make it look like I was correct.
I don't know. We'll see. I don't know if you're going to need to. A lot of these seems like they may have held true, but so I'm looking at the we have the transcription here from almost 12 months ago. I think that we said it was episode 90, right?
Yep.
People want to go back and listen to it. So about 12 months ago, Chris, you said you're going to list present your top 5 predictions, excuse me, and then we'll come back in 12 months and reevaluate. So first prediction, first 3 topics have to do with quality of assets, quantity, and pricing, I believe.
Yep.
So the first one, what you're going to see sellers coming is that they're going to want people to take multiple assets instead of just one-offs. You're going to see more assets have a little more hair on the collateral side. So I don't know which one of those was your first.
Yeah, first was the assets that are more challenging with more hair.
Okay. Well, what do you think?
For me, absolutely. I thought I've seen a lot more assets this year that had, some missing assignments on them, some, potential title issues, incorrect property descriptions. And again, where you see a lot more of those is typically on the CFD side. But, this year we've seen a lot less CFDs, and I don't know if we talked about that or not, but we can. But I think, I've seen for my paper stuff that had a lot more hair on it, including assets that hadn't been paid in 5-10 years, and you're dealing with statute of limitations issues, deceased borrowers with probates. I think the paper that I've seen this year, I learned about a MERS issue up in Maine, but yeah, I thought I saw a lot more paper that had it was more challenging. I don't know about some of the stuff that you've seen.
Yeah, I mean, I would agree with that. I don't know if some of that is just the fact that both of us were expanding, and you might buy a whole pool of 50 assets and 10 of them are junk. But so some of that could be just our own business models and growth. But I think you're right. In general, I think I can't disagree. I think that was the case. I think a lot of the assets that were floating around out there in years before have been bought up, and people are holding them.
Yeah, I mean, I used to post a distressed toxic asset list as part of the group, which most of that stuff got bought, and sometimes I'll still see that stuff come through. And you're right, it could be just who we see the assets from. I know there's clean paper out there, which again we'll talk about costs in a few minutes, but certain people I buy from, typically the stuff they do have is a little hairier, but I also get a better discount.
Yeah.
From that perspective. Now, one of the other things that I talked about besides hair is, basically finding assets in a specific market, not only hair, but kind of when we talk quality, is really what this topic was. Finding assets, people like to be in a major city near a university, and, above a certain population, a certain type neighborhood. From that perspective, what are your thoughts from what you have seen as well on that?
I mean, personally, I've had to be less picky with that kind of thing. I've seen, if I want to actually close on deals, I've got to loosen my own restrictions on, my buy box. As far as buying, I know people talk about how I want to buy close to a metropolitan area to have boots on the ground and that kind of thing. And I know you've talked in previous episodes about buying in rural areas is not always a bad thing. I think it's one of those where you've had to open up your buying expectations or maybe open up your buy box, like I said, and geographically be open to more places.
Yeah. And by doing so, you just got to wage the risk, and, you discount things more, but it just doesn't, if you looking at assets, it's because of the quantity that's out there, it's much more difficult to find some of those things, especially think I'll have to mention that too. With newer investors, they're typically looking to get something a little less pricey. So when you're looking at a major metropolitan area, property values might be 100, 200,000. And if it's a UPB of 80,000 and you only got 20 grand, you're not gonna get something in that area typically.
Right. So that was
So how'd I do?
I
What's my grade?
give you a B+ on that one. No, I think that definitely came true, I think.
Yeah, so that's a quality. So
Right.
let's talk about quantity. And as part of quantity, kind of the ability to buy. One of my predictions was tougher to buy one-offs, and going to see probably more, sellers looking to want buyers to take down more pools.
Right.
By the way, for people listening, we'd love your feedback, to post in the comments and stuff about, whether you agree or disagree, because, this is just Jamie and I and kind of who we interact with. You may have a completely different experience, and we would love to hear that. So.
Yeah. So one of the things you said was, from a quantity perspective, I'm starting to see a lot less product on the market from people. I think it's going to continue to be more difficult as the economy is still doing very well. Then you talked about a meeting you had with a well-known economist.
Mm-hmm.
So it sounds like, from a quantity perspective, it just kind of like what we were already touching on, is that there's just fewer assets out there.
Yeah.
And I think that came true. I mean, yeah, I think it's been more challenging to find quality assets. Those two are tied, quantity and quality. Can't really separate them completely. But yeah, I do think, I don't have numbers to back this up, but it just seems like from, 2019 to 2020, there were fewer tapes floating around. What do you think?
Well, I agree. And I think, let's get to the meat of it. With COVID and the pandemic and the moratoriums, certain sellers would probably just sit on their assets because, they want to kind of see where things shake out, because people may be pricing. Now, what was interesting, and this is, we'll get to pricing next, but pricing dictates also availability. If, certain asset type pricing drops because of a specific event like COVID, like non-performing loans, people were getting much more conservative on them. So pricing seemed to soften, or had the appearance of softening, and sellers weren't going to liquidate it at that price. Then, even though there might be a tape out there, but it's not getting sold. So that is, a component where, we'll get to pricing, but pricing relates to quantity in that sense of, and as well as, again, back to quality, they're all kind of interchanged. But I think COVID, kind of had some restrictions on pricing, because the people that were selling are the people that needed to sell. And the people who didn't need to sell pretty much were just sitting, holding tight to kind of see what is happening or what was going on.
Yeah, there was definitely, across the note space and real estate in general, I think, a major standstill. I mean, the expectations were way different between buyers and sellers.
Yeah, and I also mentioned, I had breakfast one time. I can't believe this has been a year already, with Martin Sines, and we were just talking about, pools versus individuals. And some of the conversations he was having with people at the time was, sellers are much more preferable on pools because there were newer investors coming in, not closing deals. And we were talking about the potential to even pre-qualify people. I really haven't seen that, but what I have seen is sellers giving preferential treatment. And when I mean preferential treatment, meaning if you've bid on something and you've closed 5 times with them and you're close, you're probably going to get that asset, versus somebody who's just buying a one-off from that pool that may have bid a little more, but they haven't worked with that person. Because, if I've got $500,000 to buy, as an example, and I bid 400,000 on a pool and they've got one asset, I'm not waiting around after they tell me that asset's gone to wait for something. They've got somebody on the hot stove like that. It's, again, back to the risk factor.
It's risk mitigation.
Yep.
Because they figure the deal will actually close.
Yep. So one other thing that I'll mention in regards to the one-offs, though, is, and this is probably a prediction that honestly, if I thought about it inside, I was absolutely wrong, is paper stack, and, kind of the explosion of paper stack. And I was curious, when that came out, how would it be treated? Because there are other platforms that had come out in the past that, had some success and so forth, but kind of slowly went away. Paper stack is one where you can buy one-off assets. it's been sustainable, and they continue to grow, and they're smart enough to understand there's other markets and business models they can add to their business line to continue to grow the business. I talk to Brett, probably once every other month or so forth, kind of what they've got going on. So, it's great to see a site like this, and there's a few others as well, where people can go, if you're new, you can go on, interact, and they walk you through that whole process. So I think that's important. That's one thing that, I'll say, I got wrong in the sense of, for the one-offs, from perspective of, there is that ability there. So I think that's great for investors who are starting out.
Yeah. I'm actually going to be talking to Brett later today. So they've done a really good job. But some of this stuff I'm reading as far as the economy, overall economy, I mean, that's, again, you didn't predict a pandemic, Chris. So it says the increased wages, basically that the economy was humming along at that point.
Well, this economist, he, again, I can't think of his name right now. He's awesome. He's at a lot of conferences, but, he joked about, right now, if, you're an economist and, Aladdin was standing in front of you, what 3 wishes would you grant? Basically he said, increased wages, low unemployment, and low inflation, which until COVID we had. And actually, if you still look at what we have right now, even during this, unemployment, I think, is back down to specific levels. Now, that doesn't mean the economy is humming right now. I think we're in for some pain. Mm-hmm. But I think, prior to COVID, which nobody, I think, could predict, you were looking at the first half of the year being stronger. And then with the election coming up, typically companies do around election, cause the economy typically to slow down a little bit, which stock market's actually been going nuts. And the reason why is they want to know what the new, if there is a new transition, what they're going to do. And I used an example like Blue Cross. If all of a sudden there's something, regarding, health insurance company all of a sudden going to, government, basically, government run healthcare, Blue Cross is kind of going to be an important player in that and be like, well, I'm not going to go buy office space. I'm not going to go hire people if I may not have a business, or my business might get reduced by 75%. So, there's a lot of that from that perspective. But so, we talked quality, quantity. Let's talk pricing. I actually think this is probably the one I was the most accurate at.
So I'd say I'll go B+ on the quantity as well. Completely.
Glad you're not grading me at Georgetown.
Completely arbitrary grading scale.
That's okay.
I just want to give you room for growth.
Oh, okay. So I go to sell you an asset again.
Okay, so what's the next?
Pricing.
All right. Yes. So you have right here, you have to focus more on bulk versus the one-off. You want to touch on that again?
Yeah, it's just for pricing perspective, you're going to get a better deal if you're buying multiple assets.
It's like buying a Sam's Club, right?
Yeah. So now here's the other thing I'll mention that as well is if there's a tape of 6 assets on a tape, and I'll say this more for new investors, and they're like, okay, 4 of them are horrific and 2 of them are like really good, and they're like, hey, this is what we're trying to get for these, and they understand that the 4 of them are really bad, and they throw like really low numbers at them. Buy them. And what I mean by that is there was a tape right before the holidays one year where it was 4 assets that they want to sell all of them. One of them was like a grand slam, and the other 3, appeared to be junk. And actually, one of them was junk, and one of them was decent, and the other one was, in between. But the cost that we were paying when you took all 4 of them added up still made that first deal really good deal. And then you had that upside. Other people were just, I don't want to deal with those other ones, so they just wanted to buy that one. And the seller's like, no, I need to get rid of all of them. So like, we'll buy all of them. And by doing so, you gotta remember, you're solving that person's problem of, I need to get rid of this crap. And I'm not just going to give you, the gold brick. I want you to take the polished turd along with it. And, sometimes you got to, take that component. And by doing so, you'll be surprised, how many deals can come along after that, because they know you'll take on something. Even if you have to write it off, you're still, think about it. The asset was 20 grand. You can get it for 18 and you're buying two other assets at $1,000 a piece. You're still paying 20 grand. Think of it for that asset. And the other two are almost free.
Yeah. I'm rereading Chris Voss's book, Never Split the Difference. And you reminded me of it. Basically, instead of being so narrow-minded about, your particular deal that you're looking at, and you're looking at it from your own perspective, running through your performing calculator or whatever calculator you're using, think about it from the other person's perspective. So it really does, it factors into negotiation in general. You're solving, like you said, you're putting yourself in their shoes and you're solving that problem for them. It's not just about a price, it's about, solving problems.
And here's an example of a problem I solved for somebody. Let me know how this turned out, people. There's an asset, Chapter 7, borrower file Chapter 7, haven't paid in 6 years. Actually a condo, probably worth about $40,000. Condo fees are actually paid, taxes are paid. Gets thrown into a pool of assets I bought. I think the number on it was $1,500. I'm like, okay, $1,500, asset hasn't paid in 6 years on a condo, in a tough area. It's going to cost me, 7,000-8,000. Holding costs will probably be about 10 grand. There's still ability and stuff. There's still some money to be made in this thing, potentially. Condos can get really tough, and if this needed work and stuff, the condo is basically a $10,000 condo. Borrower attorney reaches out to my attorney, because we sent a letter, and says, oh, the borrower thought because of Chapter 7, they didn't have to pay the debt and they got the house for free. So of course, my attorney's like, you're an attorney, like, hello. And she's like, yes, I know. What can we do? There's, the UPB is, out 40, 50 grand, total payoffs like 80,000. Can we get a mod? Well, yes, 1,500 down, I think what I paid for it. And then let's get on a payment plan, and then, I waived whatever I can do. But all of a sudden now, this person's basically, I think they actually paid yesterday. It took an asset that I thought was basically worthless or not going to make anything. Now it's turned into a complete grand slam, or it's looking like it should be. I never count my chickens before it hatch, but sometimes crazy stuff like that happens when you deal with numbers and in bulk.
Yeah, and you're kind of listening to their side and figuring out a creative way to solve the problem.
Yep. So in regards to pricing, though, I talk about you have to focus more on bulk versus one-off. I said performing notes on CFDs were originally at 15 to 18. Then in beginning of 19, they were 12 to 15. And then I thought for 2020, they'd go down to 9 to 13 and maybe 9 to 11% for performing notes. Oh, no, then I said at the end of the day, I thought performing a note would be between 9 and 11 and a performing CFD 10 to 13. On non-performing stuff, I thought you're going to see them over 50%.
Definitely nailed it on the performing. I'd say both.
So if you give me a B+ right now, I'm going to reach through Zoom and strangle you on this one.
That's a solid A for sure.
Yeah.
Definitely on the performing CFDs and performing notes, the yields have just come down.
Yeah. And it's been, for me, it's, I'm sitting on, 50 plus performing assets right now. And it's like, okay, do I sell them or hold them? And for me, it's been kind of, you got to, again, look at all three of these in perspective. It's in a fund that I have. If I turn around and sell them, what am I going to do with that money? I don't want to go buy a performing asset over 50%. Yes, there's pools I can buy and so forth, but my fund closes next year. I buy non-performers. Do I have time to flip them? Which I don't think I do. So it's like, okay, we're just going to, let them sit, let them ride the wave. And I actually thought this year, because of COVID, I thought people were overpaying for performers, because I always thought there'd be a greater chance for them going delinquent because of the risk involved. And I thought actually, as COVID hit, first thought process I had was, oh, non-performing pricing, may actually go up and performing pricing may go down because you see more people coming into the business who, so it'd be more demand versus supply, just like on the housing market right now. So I thought that would drive up price, but it's actually been opposite, which is kind of backwards for me. Non-performing, I've seen dip a little bit because of foreclosure timeframes, and the performing have gone up. And I almost see that as, so I've been buying a lot more non-performing because of factoring in the foreclosure timeframes and getting them well under 50%. And the performing, I'll buy one-offs here and there just because I thought, they're too high in price.
Yeah, I think your approach is logical. And a lot of other people, frankly, were more basing their pricing, and their expectations out of emotion. So fear, so the people want safety in a time like a global pandemic, right? That makes sense.
Yep.
So you rush to what appears to be safe, which may be a performing asset with equity, as opposed to buying something, like you said, with moratoriums in place and you don't know how it's going to play out. There are a lot more variables there potentially on a non-performer as far as timeline. So I think you're right. I mean, it makes a lot of sense what you actually did this past year. And yeah, I mean, the pricing on performing notes and CFDs has definitely gone up and yields have come down. So nailed that one for sure. And I do think, I think that there's been more of a gap in pricing between performers and non-performers, which I think in 2018, 2019, you tell me if I'm wrong, it seems like that pricing had kind of merged a little bit. It was almost hard to tell them apart, whereas now there's a lot more separation. Would you agree with that?
Yeah, I would.
Gotcha.
So one of the things that I kind of talk about as well, and I don't think this was actually number 4, but it's kind of was thrown in there. I said, I'm somewhat saying for people who are looking to get into the business and do it on their own, it's not the most ideal time. I'm just being completely honest. I'm not pushing people away. I love the business. I think it's a great business, but I was just telling people, be careful. You may want to look to partner with somebody to get a better understanding of things. I'm just telling people because, warning signs are off on getting assets that are much hairier in collateral issues and borrow issues, and people were paying more for them. So pricing was going up. Assets are getting hairier, which increases risk. Things can turn ugly pretty quickly. It wasn't a doomsday is what I put in here, but I was thinking, people should be more cautious just running into the business, kind of, blindfolded.
Yeah, I remember listening to this episode, and I wish I hadn't. No, I'm kidding. But I mean, you try to tell it like it is. So that makes a lot of sense. And I know people have lost money. We don't really like to talk about that so much, but yeah. Well, we'll talk about next year later, but curious to get your thoughts on that. But so that was kind of a side note.
That was a side note,
after those first 3 predictions. So we're going B+, A.
Yep. So I think the next one was pop-up trainers.
Yeah. So you're going to see a lot more people pop up in training who probably could be questionable whether they should be doing training or not.
I did say that, in 2020, I would not have any training, which
the answer is a hard no.
It was a hard no because you got to be all in. And at the time, I don't have the time. 2021 for what, our business plan, things could change in there. But, I mentioned kind of, with the pop-up trainers, I thought people needed to basically have made over $1 million in something, not somebody who made 50,000 off of buying 10 notes. But, from pop-up training, I don't know. Have you seen any more pop-up trainers?
It may just be that I'm more aware of, the general landscape of note training. I mean, there are more people that I'm aware of now that are doing some training, but I don't know.
Yeah. So for this, I was kind of going down 2 roads. One was the pop-up trainers, basically just somebody randomly coming up with a training course. And then the other one is the individuals who throw out a new training from one day to the next, where one day they're teaching notes, the next day they're teaching infinite banking, the next day they're teaching subject to, the next day they're teaching wholesaling, the next day they're teaching multifamily properties, the next day they're teaching lease options, and these different lifestyles as well. I've seen people come up with those. Actually, I don't know. This one actually, I don't think I thought there would be a lot more personally. So this one, there's been trainers who I'm surprised are still doing training that have come out from that perspective. But this one, I thought people would get a little more hungry trying to take advantage of people getting in the business, and haven't really, seen that much of an increase. I thought I would have seen a lot more increase on this one personally.
Yeah. So I think we're going to have to go B- on this one.
Okay. Yeah, I'll offset that with, from B+, because probably I would have given myself a C on that one.
I mean, I don't think there's been a major change. I've noticed a couple other, people starting some training, and whether it's online or, in person, and I'm not suggesting they shouldn't be, but I've become aware of more people introducing some training. And I don't know can you think of any, like, kind of, you don't have to name names, but big name trainers who are no longer doing it? I guess what I'm getting at is, I would say there are more training programs out there than there were the previous year.
Yeah, I've seen a lot more. I've seen people ramp up if they're doing something, once a quarter. Now all of a sudden it looks like a lot of them are trying to do stuff like once a month or more frequent. The frequency from people, I think, has increased. Maybe not the number of people, but the frequency I've seen, increase. Also, in some aspects, I've seen pricing significantly increase on training as well.
Yeah. So yeah, not a major change there, but then the last one has to do with regulation and oversight. So you say that you're going to have to see more and more people getting licensed in certain states. So you say as investors, 99% of us try to do the right thing and try to follow the rules. But that's not always the case with all hedge funds or other investors. So
I see investors who, will take a property, they'll buy it under land contract, try and wrap it under lease option financing, and, basically just, create chaos. And, there was one instance where a woman bought a property with hard money, then got it under land contract with somebody, but refused to give them a signed copy of the land contract. So they stopped paying, but they were living in the house, and they went after the guy. And, basically I'm sitting there looking at it. I'm like, okay, if I'm this guy's attorney, I'm like, basically, yeah, I'm not paying because I have no contract in place right now, and oh, by the way, give me my deposit back. And the hard money guy was foreclosing on the, on the individual because they weren't paying. And then they were like, oh, we'll sell you the contract. I'm like, okay, I'll give you 20 cents on the dollar, because, of all the issues that are going on with it and stuff. And I'm like, I could just go buy it at foreclosure sale.
Yeah, this is definitely a topic we need to dive into in the future episodes. As far as licensing and regulations, and it's more than one episode, but because on one hand, I think you have newer note investors who are afraid to do anything, because there's risk with licensing and regulation and all this stuff, CFPB, Dodd-Frank, but then also the state level security, securities organizations, and then they end up not doing anything. And the other extreme is people just doing whatever they want. So
yeah, it was like the person in our Facebook group mentioned the other day, and I can't remember the name, but they're like, I want to buy a property that's boarded at FCI. The borrower is deceased. It's in foreclosure. I want to buy it, but I don't want to board it with a servicer. And I'm sitting there thinking, I post something like, well, what can go wrong if I don't have it as service? What would happen if it's not serviced? And I'm sitting there thinking, if you can't answer that question, you should not be buying a note. First, that was first thought in my head. But secondly is, for people, if you want to understand the licensing in a state, talk to an attorney in that state that goes through this. There's the website NMLS. Again, that's Nancy, Mary, Louis, Sam. Google that, and there's basically every state you can look up. And in most instances, you're a lender, but not considered a debt collector. So there's different avenues for that. So you kind of got to read through which one it is, but also talk to an attorney, and see what so you get an understanding. Maybe talk to them, then go read MLS and so forth. But yeah, I mean, regulation wise, everything kind of with COVID got put on hold. It was regulation within COVID, but a lot of states and stuff that are working on laws and everything pretty much got, pushed and put on hold because of, everyone working from home and remote, and basically people kind of just, I think, try and keep their heads above water. Now, with, new administration coming in the door, I still don't think I think, CFPB will get a little more teeth, back to their bite from that perspective. I personally don't think we're going to see any major, changes. Again, this will be 21 predictions, but just talking about 2020, again, you've, still just got to be careful because of lawsuits, like I said, with Harbor Portfolio, Vision Properties, especially on the CFD front, but even on the note space, it's got to be smart about it, and, don't do something stupid. Now, I will say they did just come out with, and I haven't been able to analyze it all, the new debt collection laws or regulations that impact like text messaging, how many times you can call. There's a lot of information that's still being digested because that decision, I think, came out October 30th. I am a member of ACA International, where they do webinars and stuff on this. So once I get on those, I'll share a lot of that information for people. But so it's going to be interesting, kind of, they're finally, updating laws based off of email and text messaging and what you can and cannot do.
So I know you've had attorneys on with regard to some like Ohio CFDs and then I know everyone got spun up about Maryland, or whoever was interested in Maryland having the debt. Was it the debt collector license?
Oh, I love that. I still go back and look at that, and I'm like, people were like, that was like the boy who screamed fire or boy who cried wolf, because everyone's like, you need it, and then I'm sitting there behind the scenes, I'm like, no, you don't.
Which is usually the opposite.
Yeah, it's usually opposite. But I was buying up Maryland assets left and right from people just afraid and dumping them, and it's like, it's like kind of, I'll take it's the what's the Eddie Murphy movie, Trading Places. At the end where they're, they kind of switched the briefcase and they knew what was going to happen, and Eddie's just sitting there, basically, I'll buy. That was me, and all of a sudden it's like, you don't need it, and then I'm like, I'll sell. So that reminded me of Maryland.
Well, that's how. Yeah. So for Georgia, Chris and I will buy all your Georgia assets.
Well, no, Georgia, you didn't need a license.
You do. I'm just, yeah, true. That's I guess the converse, but yeah. So I guess what point I was getting to was neither of those actually came to fruition, right? I mean, as far as Ohio cracking down or Maryland cracking down, or, so it does seem like people do get spun up on some of this for particular states, and then sometimes it doesn't actually happen.
Well, Ohio on so there's two things with Ohio. One was the CFDs I talked to Franco not too long ago. He said that's stalled. But Ohio did, they have licensing now that is very restrictive in how it's understood. And I was on the phone with their regulators and everything, where they, to get that license, you have to have an in-house MLO with 3 years experience. And that is, most note investors do not have that. So I'm curious, like people are like, oh, I got an Ohio license. And I post on groups and stuff. I'm like, somebody send me a picture. I'm curious what your Ohio license looks like. And it's crickets.
This is for debt collector license or for lending?
No, owning notes. Note investors in Ohio.
Got it.
By law, because you are considered, the question they asked me is, I'm like, well, I don't service a loan. I have a third party. And they're like, have you ever modified a loan in the past? And I'm like, yes. And they're like, then you're a lender. I mean, you fall under an MLO, because for a modify a loan, you should, but we want that person in-house. And I'm like, okay. So, yeah. So Ohio is, one of those states that thankfully I had the foresight 2.5 years ago to get an MLO license. So this April, I will hit my 3-year mark on having an MLO.
So would you say, looking back at 2020, what states were, I mean, you're in 34 states or something.
34.
Your number of states equal my number of loans. So how would you say, I mean, I think COVID was a major factor. You've already touched on that, but any major changes in 2020 with regards to licensing?
I think, certain states that had licensing, I think they're starting to look at a little, as they plan for the future, they realize they're starting to look at it a little harder because I think they see what's coming down the pike in next year from that perspective. But I mean, here's the problem. I play by the rules. So I don't typically, I try, well, not typically, I try and stay as compliant, if I ever miss something, hopefully I don't, but I'll fix it very quickly. But I, knock on wood, nobody's ever picked up the phone and said, hey, what do you have this and so forth. But, so,
I'd say there hasn't been. Yeah. It doesn't seem like there's been major changes, just tweaks as far as across the country.
Yeah.
But again, that's a pandemic. But yeah, I did just, with our interview of Dave Van Horn last night, that was one of the cool things I took away was he said, just tell me what the rules are and I'll figure out how to win. Basically, I'm paraphrasing, but yeah, don't get all spun up on what might happen as far as the regulations and licensing. Just be legal, be ethical, and still figure out a way to be successful. So that was pretty good.
Yeah, I do think kind of how I run my business.
Yeah. I mean, again, we're not talking 2021, but I could see just, I think states are going to be cash hungry with paying out all these benefits to people. And with the unemployment rates so high, that means people weren't working. So they're not, I mean, revenue for states has definitely been down this year. So my cynical side says they're going to be cash hungry next year and probably ratchet up some of the, regulations and licensing for that reason.
So one other kind of, some additions to this before we wrap up the episode. We talk about people pulling out of stock market and looking for other avenues to invest in. I think that's always the case. People like real estate. So, stock market's at all-time highs. If you've been in it, great. But I always think people are going to try and diversify. So that's kind of a cop-out statement almost.
Yeah, I don't know. I don't know if it's just the world I'm running in, but I do get that sense that more and more people are looking for an alternative. So
here's an interesting thing though was I'll just mention is, we had targeted, last year, having like 12,000 downloads and we ended up with over 55,000. And this year I questioned the numbers on 4 different occasions, but as you have 100 episodes kind of just sitting out there and people, home and stuff listening and so forth, kind of exceeded expectations on the number of downloads that we've hit. Because we are, I think, over 800,000 downloads.
That's really impressive.
Yeah. I had them checked out like 3 times and so forth.
Do you pay your VA to download, 500 times a day or something?
No, actually,
just kidding.
I do pay the VA to, post stuff on Instagram and the episodes and stuff like that. But, we've got, we get like, some downloads in like Israel and some other countries as well. And, per episode. And like I said, it's not just new listeners because new listeners will jump in and, say we start out with maybe, 300 or 500 listeners or whatever it may, which isn't a lot. But then if you're adding, a few listeners every month, going back and downloading all the old episodes along with the new ones, 10 people download, if they downloaded every episode, and again, does, downloads versus listens, that's a whole nother topic. But, if they downloaded, 10 people downloaded all of them, there's 1,200 downloads right then and there. So, because we are up over 100 plus episodes, which, I always wonder like, okay, how long would this last and stuff? And, it's like anything in business. If you're consistent and keep doing it, it will lead. And that's kind of what we took away with Dave Van Horn last night. Keep plugging away and good things happen.
Yeah, he was talking about how he would write for Bigger Pockets for 7 or 8 months and didn't think anybody was reading it, but eventually it caught on. So on the fifth one, I'm going to give you a solid B because nothing really changed too much. Hard.
Yep.
So we'll say B to B plus overall.
Okay. So, good. I think, to try and predict, is, as I joke when I started this, it's just like taking a dart and throwing it against a wall. I think for 2021, we'll see what our predictions will be, and I think we'll have to, be a little harder on ourselves, on certain things. I think it's, the question will be, okay, is there going to be cheating if we say foreclosure timelines are going to take a long time because courts are going to be backed up? I mean, hey, we can say that. I think we're going to be right, but it's still things we should throw out there just to let people know because newer investors, need to know that information.
Yeah, a couple of them should be some bold predictions, maybe.
Yep. So did you? He's pulling out the pad. What's the note and bolt for today? Or actually, let me step back. Would you like to add anything?
I think.
What did you think was going to happen in 2020?
Oh man, I don't have any really commentary on that. I think you did a good job for sure. So
on our next episode, what we're going to do is we're going to talk about, okay, what did we think for our businesses, how we would do in 2020 and how did we do?
I will say, now this is, not a prediction, but it's like when everything started shutting down, we'll just, March, April, May, whatever, a lot of note investors and people in general were just kind of stopped in their tracks. And people were saying, do I just not do anything? And I get it for a little bit, but at some point, what I would say, here's a free note and bolt, you just can't wait around. So it's like you said, you do want to have, if you have money, do you want to have it just sitting there waiting for this great deal 6 to 8 months down the road? I mean, to me, I learned by doing, and it's like, just, I kept buying through this year, I guess is my point. And so, and I know you did as well. Not suggesting you bury your head in the sand and don't adjust to the market conditions and circumstances, but you don't know what's going to happen. So you just kind of keep moving forward. So anyway, it's a free note and bolt.
So here's my note and bolt because an email just popped in on, and this is, I think, a note and bolt that you may want to take a look at as well. I had a property that we sent the demand letter and it came back returned to sender vacant, unable to find borrower. So I asked the attorney, hey, can we just go winterize the property? And she said, the mortgage does not give you the right to secure a property if it's vacant. The mortgage is actually pretty scarce for lender protections. She's like, I haven't looked at this issue for some times because 99 out of 100 times the mortgage gives you the right to secure a property if it's vacant. She said, I know someone at a bank I can call in the meantime, but do not take steps to secure the property.
Okay, a couple questions.
Yep.
One, what state is that in?
Pennsylvania.
Two, I'm assuming that's not a CFD.
It's a note, yes.
So CFD would be, there's one upside to a CFD. It's your property, right?
Correct, yep.
So that is a positive there. Yeah, I definitely need to research that.
Yep.
For at least 2 of these New York loans.
Yeah, so, but, and I'll reach out to her because, if I go in and winterize a property, will they know? But in the same token, if they see the sticker there, they'll be like, hey, what were you doing in the property? You didn't have the right. So it's one of those. She said I could certify it as vacant, but it's very expensive in that process. So
interesting.
Just have to find him. So that's a note and bolt.
Nice.
As Matt Kelly typically says, read your mortgage and note because it will typically tell you what you can and cannot do.
That's a good point.
Yep.
So my other one real quick, that other one, that first one was a bonus. My real note and bolt is check out noterules.com. It's the Portfolio Activity Center. Richard McGrew made this software based on Podio. This is what we use for our workflow system. Not trying to push it on anyone, but we're pretty happy with it. And so if you have any questions about that, let me know. There are different payment options, and you can do all kinds of things. So it's Podio, but it's software that's meant for note investing. So that's what we use, and we're really happy with it.
Yeah. So let me ask this question, because I'm not familiar with it. I actually have a call with Richard, I think next week. You know, we kind of talked about that, but you know, I want to kind of just get a better understanding of the software. You know, I told him, I'm like, I have no interest in using it. I already spent 20,000 on software. I'm not going to spend, you know, change software. But I was curious, is this for somebody that only has 1 note? So you should have 10 notes. I mean, what type of investor should be looking at this? How is it for a newbie, and can you scale with it up to, you know, 50 or 100 notes?
So what's nice, I'd say you don't need it if you have 2 or 3 notes. But
Okay.
I think if you have 5 to 10 notes and you're planning to scale, you need something like this. It doesn't have to be this product, but one nice thing about it is really inexpensive. You can go with a basic plan. So somebody that has 8 notes and they don't want to pay a lot, it could really work well. It's not a fancy looking system. You've seen Podio, you've seen it. It doesn't have all kinds of bells and whistles as far as how it looks, but I find it user friendly, and it's actually, I think Citrix bought Podio, so it's a, you know, I asked Richard, I said, well, what if something happens to you, then what?
Yeah. Oh, Citrix. I didn't know Citrix bought Podio.
Yeah, so it's backed up by, you know, a high quality company, right?
Yeah.
So I guess what I'm, you know, I don't think it's going anywhere. There are better systems out there if you really want to go crazy, you know.
Mortgage office.
Right.
If you want to drop 10 grand. 10 grand for the system, then if you run a fund, there's another 10 grand.
Short answer is I think 5 to 10 notes. I don't know about you, if you can remember when you had 10 notes. I think once you get into double digit notes, it's kind of a lot to keep track of if these are non-performers and CFDs. And I think you need some kind of workflow management. So we have that for our workflow management. And then we also have, you know, Google Drive and other systems. But then but it does give you, the second part of your question, it does give you the ability to scale, because one of the things he's starting to do now is get into doc prep and automating that process, which is pretty neat. So we haven't started with that yet, but that's something we're looking to in 2021 as far as automating doc prep with, you know, for all kinds of different reasons, but also he's starting to pull in servicing information directly into this workflow system, into Podio, so that you don't have to necessarily go into your servicer's portal. We'll see how it all plays out, but he's expanding the system, but it also gives you their different levels so that you can scale within that system.
So, you know, we could do a whole nother episode on kind of where I started. I think I was using Pipedrive originally. Then I spent a few $1,000 in using Infusionsoft. Actually, I implemented a management system in Infusionsoft, which was tied to something called Airtable. But that actually went pretty quick because I used that when I had, call it like 40, 50 notes. And then I went and started a fund and bought like a 90 pools of asset. And that was the point of like, okay, I need something that can really be robust. And was talking to, I think it was like Juniper and some of these other third-party fund managers, and they wanted, it was like a $1,500 a month minimum. And, you know, you look at it, the course of, you know, 24, 36 months of a fund, now that's $36,000 to $48,000. So for me, that's where I was like, okay, I'll go with the mortgage office. I bought it, basically it was, I think it was roughly, call it 10 grand. I don't know if it was 8 or 11 or whatever magic number was for the main system. That was my investment. And then, the fund portal component to it, because it's completely separate, gets charged to the fund. And then on a monthly basis, there's still a fee that I have to pay and stuff for the number of users I have on there, and also the number of funds I have. So it's still got a monthly recurrence, but some of that is recoverable from the funds. And at the end of the day, it actually saves the fund money, because I would, like I said, instead of spending $36,000+ on a 24-month fund, probably going to may have cost 12,000, 15,000. So I mean, that's 20 grand. That's a good amount of money.
This is a software that servicers use, right?
Yep. Yeah. So I know Madison uses it. Your buddies at Lake City used it. I Allied does not use it. FCI, I think, created their own system that was kind of like based off of Mortgage Office. So I think there may have been, let's just say, a dispute or a lawsuit on that. I heard that through a grapevine. I don't know if it's true or not. So I don't, but a servicer actually told me that. So something, could check to see, but it really doesn't matter. FCI, I heard, has an awesome portal.
Mm-hmm.
So yeah, that's how I kind of grown mine. I think I've, already tossed a few notes and bolts in there for people, but
yeah.
Anything else as we wrap up this episode of the Good Deeds Don't Investing podcast, Jamie?
No, sir.
Okay, well, as always, feel free to listen to us on all stations where you download your favorite podcast and go out and do some good deeds. Thank you, everyone.